Welcome to the Ellsworth Advisors monthly update for March 2026. I'm Kelly Keenan. This is Cameron Mealy, and today we will review the latest market data for March and also economic data and what we think is going to happen moving forward. Cameron, why don't you kick us off with some economic research?
Perfect. Thank you, Kelly. Good morning, everybody. For reference, today is Tuesday, April 7th. We'll jump into the numbers, Kelly, something we always talk about. Let's focus on GDP, the biggest of the numbers. On March 13th, the Bureau of Economic Analysis reported that according to its second estimate, GDP in the fourth quarter increased at an annualized rate of 0.7%. Now, as you'll remember from our last video, the advance rate issued in February showed fourth quarter GDP increasing at an annualized rate of 1.4%. So we basically have that number. And for the year, GDP increased 2.1%, which is down from 2.8% increase in 2024. So if we look at 2025, we had 0.5% decline in the first quarter, 3.8% increase in the second quarter, a 4.4% increase in the third quarter, and now what appears to be a 0.7% or a significant slowdown in the trend for fourth quarter GDP. What's interesting is if you advance that forward and you look at the Atlanta Fed's GDP Now forecast model, as of this morning, April 7th, their new forecast for the first quarter is an annualized increase of 1.3%. So we've seen both as GDP has come down, we've seen the Atlanta Fed's GDP Now forecast come down. Obviously, Kelly, a lot of this has to do with energy prices, has to do with the disruption in the Iran hostilities. But at least from a number-wise, I don't think we can feel it right now, but we're definitely seeing in the numbers that there is a slowing of the U.S. economy.
Oh, absolutely. It was coming. A lot of strategists have kind of seen the softening. We're definitely in softening phase. With this last month of being with the Iranian conflict, definitely introducing possibilities of recession. I know we had talked about that, potentially last year. I'm kind of in the same mindset that, yeah, if there is a recession, it'll probably be fairly mild. But the economy is mature. 2% growth it's growth, but mediocre at best. You get the higher inflation, that definitely is slowing us down. And the biggest risk right now is, inflation due to higher oil prices, which is probably the
Yeah,
next thing
we're
on
gonna
your list,
yeah. So
right?
let's run
Jump right in.
through the three measures of inflation. The producer price index on March 18th, the Bureau of Labor Statistics reported that the producer price index increased 0.7% in February. On a year-over-year basis, the index is up 3.4%. Now, this is the highest increase since February of 2025. So again, seeing a tick up there. Personal consumption expenditure index, or what we say is the Fed's leading gauge of inflation. Now, this one is in a month delay due to the government shutdown of last year. They're still catching up. But on March 13th, the Bureau of Economic Analysis reported that the personal consumption expenditure index increased 0.4% in January. For the 12 months ending January, the index is up 2.8%. So we're seeing 3.4%, 2.8%. Let's turn to the consumer price index, which right now is trending in the best direction. On March 11th, the Bureau of Labor Statistics reported that the consumer price index increased 0.3% in February. On a year-over-year basis, the index is up 2.4%. So, slowing economy, inflation is still not where the Fed wants it to be. Last month, we would have talked about the employment situation, but now this month, we had a very bang-up jobs number for March. On April 3rd, the Bureau of Labor Statistics reported that in the U.S., in March, the economy added 178,000 jobs. The unemployment rate decreased to 4.3%. And the consensus estimate from Dow Jones was 59,000 new jobs added. So a significant increase, really the first monthly surprise to the upside that we've seen in the jobs numbers in a long time. But I think the writing is on the wall. Everybody is expecting, whether it's AI, whether it's a slowing economy, the pace of hiring is not going to keep up with population growth. There are two quotes here, and they essentially say the same thing, but they say it a little bit differently, but I think they're both telling. First quote is from Heather Long, chief economist at Navy Federal Credit Union. The bottom line is March was somewhat encouraging, but it's been a rocky year for the labor market with almost no hiring since last April. The March data will keep the Federal Reserve on hold, but no one is declaring victory yet. It's likely to be a tough spring for the job seekers. Second quote, this is from Jeffrey Roach, chief economist for LPL Financial. This year will most likely be a year of shifting labor dynamics as artificial intelligence upends the job market, especially for low skilled roles. We continue to see healthy job opportunities for workers with experience. Average hourly wages increased 3.5% from a year ago, giving consumers enough buying power to overcome nagging inflation. This upside on the job market gives the Federal Reserve more time to wait for inflation to decelerate before taking action. So I think this gives, now we are going to have a change in the Fed regime. Jerome Powell is on his way out. Um, the Fed is likely going to push to be more aggressive this year. That's what the president wants. That's what his administration wants. But I think when you look at the slowing economy, when you look at inflation, still very elevated, when you look at an uneasy job market right now, at least in the near term, unless something breaks, something major happens, I can't see the Fed doing anything but standing pat.
I I agree. I think where rates are kind of makes sense in
Seems
this,
appropriate.
in this, where the inflation numbers are, where interest rates are, do make sense. They're higher than what we've been used to in a zero interest rate environment, but we're also not looking at late 70s, early 80s type interest rates either. And, it's just a situation where the economy's kind of evolving, transitioning, because of what's going on in technology, which is all very positive and the end result is going to be good. But, the economy's going through transition.
Yeah. Well, and
Always
let's,
go through these
yep.
transitions, and this is, if we can get through this one with minimal damage and without a major recession, I think that would be a success.
And let's look at really what has caused the low to zero inflation environment. I mean, it really started with the financial crisis. I'm sorry, the tech wreck of
Yep,
2000, 2001, the financial crisis of 2008, and then we had COVID.
exactly.
So, I mean, there have always been these reasons why the Fed has had to pump money into the economy via their interest rate reduction. So, I think hopefully we're at the first time where we're not going to have some kind of giant shock that's going to artificially pull. We can finally live in a normalized rate environment.
Right. And, hopefully not have to flood the economy with cash.
Yeah.
If we don't do that, kind of get, work through this, which, some things aren't as easy as they used to be. Like investing in the stock market, just throw all our money in an index fund and, number go up. Well, that's not normal. It seemed normal the last 10, 15 years. And the reality is, yeah, you kind of have to be conscious of what you're buying. And if you buy good quality companies that are, making money or there's a path for them to make profits and you're buying at reasonable prices, no matter what's going on in the economy, you can still kind of get ahead. Which leads us to what's been going on with the markets. Obviously, a little war started last month, and that's definitely had an effect on the major averages. Um, in March, the Bloomberg Aggregate U.S. Bond Index down 1.76%. That's because rates have gone up a little bit on the longer end. The 10-year Treasury now around 4.3.
Yep.
Went into the month, it was closer to 4% to 4.1. That's obviously put a little upward pressure on mortgage rates. Now we're in the mid sixes, and I think that's going to be a reality for a while from a mortgage standpoint. The S&P 500 for the month down 4.98%. The Nasdaq down 4.68%. The Dow Jones down 5.24 March, and then the Russell 2000, which is small caps, down 5%. The MSCI EAFE Developed World International Stocks down 10.19%, and the emerging markets down 13.03% for the month. So pretty rough month with
Pretty
the
rough
war,
March.
and we'll talk about how our stuff did. Year to date, bonds are now negative 0.05%. Um, the S&P 500 year to date through the end of the month was down 4.33%. The Nasdaq down 6.96%. The Dow Jones down 3.19%. Small cap stocks as measured by the Russell 2000. Year to date, still hanging on to a small gain, 0.89%. International stocks measured by the EAFE down 1.2, and then emerging markets down 0.1 year to date. So, you know, most of the damage being done this month, but the major averages, the Dow and the S&P and Nasdaq, they were still pretty weak going into the month. Our portfolios held up fairly well. We did feel pain in March. Our growth with income portfolio down 3.5 for the month. Year to date, we're still up 5%. Big gainers, EOG, which is an energy company, up 16%. Exxon, another energy company, up 11.25%. And our commodity ETF, HGER, is actually up 10% for the month.
Is this going to be a trend as we go through this
Trend
update through
has
the month?
been there, and it's just exposing itself more so. Laggards in the month in this portfolio: Lennar down 24%, Nike down 15, Toyota down 15%. Gold actually pulled back 11%. So you had broad-based commodities go up, but gold actually pulled back. And then microchip technologies down 13. Gold's interesting in that when the war started, the dollar weakened really quick, and that kind of caused the 10-year to go up. And gold is sensitive to the dollar more so than other commodities. Obviously, the energy, oil driving up the broad-based commodities. But gold, because the dollar strengthened, gold came down. We've seen a little bit of strength coming back
And gold has
last
had
couple
a
days.
tremendous run.
Oh yeah,
So this is a blip.
this is the end of the parabolic move. We've been in there long enough where we still hold on to a lot of gains there. Year to date, Exxon up 40%, EOG up 38%. The commodity ETF up 25%, Caterpillar up 24, Digital Realty up 16.5. Year to date, Nike down 17, Disney down 15, Lennar down 15 and a half. Our dividend yield portfolio, once again, for the month of March, down 3%. Year to date, still up 7.5%. Once again, the big gainers in the energy space: Chevron up 11, Enterprise Products up 5, AT&T up 3.5 in the month. Public storage down 12%, Medtronic down 11%, Amgen down 9%, Darden Restaurants down 8%. Year to date, Chevron's our big leader, up 36%, J&J up 18%, um, Enter- Enterprise Products up 18%, AT&T up 17%. Year to date, laggards: Medtronic down 10, Old Republic down 7.5, US Bank down 2.5. Our appreciation with income portfolio in March was down 6%. Year to date, we're still up 1%. Once again, some of the big gainers in March: EOG, March laggards: Amphenol down 13.5, Freeport McMoran down 14, Eli Lilly down 12.5. Year to date, EOG, once again, big winner here, up 38%. Lamb Research up 25. Kinder Morgan up 22. Laggards: Microsoft down 23.5. Thermo Fisher down 16%, and Broadcom down 11. So obviously some stress in the tech arena. Price potential for the month down 3%. Year to date up 6.5%. So nice little year going there. Once again, gainers: Petro Brazil up 25%, Marvell Technologies up 21%, Dell up 11, One Oak up 9, laggards: Anglo Ashashi Gold down 24, Commercial Metals down 17, Meta down 12. Year to date, Petro Brazil up 75%, Technip Technip FMC up 55%, Vertiv up 55%, Artrock up 34. We have taken some gains in Vertiv just recently. Some of that actually we bought it a little bit more in Microsoft with those gains. But year to date, Microsoft is down 23.5%, Eli Lilly down 14, and Sanmina down 14%. Um, Small cap stocks, year to date down 4.5. I'm sorry, March down 4.5. Year to date, we're up 1. Um, Big gainers there: Alpha Metallurgical up 26, Black Sky Technologies up 33.5, Lincoln Education up 12.5, laggards: Astronics down 17, Apco Securities down 15, Immunovent down 10. So the downside wasn't as bad in small caps as I would have thought it would have been.
Yeah.
Year-to-date gainers: Lincoln Education up 68%, Gorman Rupp up 30, Parker Aerospace up 25, Nickel Industries up 22%. Laggers we still in the portfolio: Napco down 5.5, Matthews down 1. The rest we've kind of traded through. Um, so in general, I mean, the trend is the technology stuff is definitely challenged right now. What's definitely been working is materials, energy, um, even telecom is, telecom is
Mm.
bad, was on its back for a long time.
Yeah.
Finally starting to
Yeah,
move
I
there.
mean, you've talked about we're seeing a little bit of a rotation. We're seeing some broadening out. The historical stocks that we focus on, quality companies, quality balance sheets, they're working right now and they're working well. Our portfolios are doing great. But I think the theme for 2026, as we talked about, is there's going to be volatility. We've got a
It's gonna be
war in
volatility.
Iran, we've got a war in Ukraine, we've got midterm elections, we've got inflation bugaboo hanging out there. I mean, there's going to be a lot of headline risk. And we're going to see a lot of days where the Dow is up 800 and down 800. Um,
But there's
Probably.
Yeah, but there's a lot good going on. Companies are
Absolutely.
still making money. People, the worker, or people that have jobs, salaries are increasing
Yep.
because of higher inflation, so that's good. AI is changing the landscape a little bit for the jobs people do, but the jobs will still be out there. They're just gonna be a little bit different than what they were. And the end result of a lot of the technological advances being made is that when companies start using it, it's going to help their productivity, it's going to help their
Absolutely.
profits, and that's really what matters in the long term. So once again, we want to be selective when we're buying, um, conscious of upcoming needs for clients, make sure we have dollars that are available. But in general, the key is diversifying in what we do hold, but also, sticking with quality companies.
Yep. So with that, we'll talk to you again next month. Hope you have a great month. And if you need anything or you want to discuss your accounts, please let us know. As always, we thank you for the trust you've placed in Ellsworth Advisors. Have a great month.
Thank you.